One ended up with $3.1 million, the other with $430,000. Two people, same age, same job, same $100,000 salary. One retired at 60 with $3.1 million in a tax-free account. The other reached 65 with $430,000 and had to keep working because it wasn't enough. They didn't come from different backgrounds. They didn't have different incomes, different opportunities, or different levels of intelligence. The entire $2.67 million gap between them came down to one decision made at age 25. That took about 15 minutes to set up. This video is going to show you exactly what that decision was, why it created such a massive difference, and how you can make the same move, whether you're 25, 35, or 45. The setup. Two people, same age, same income. One starts investing at 25, the other starts at 45. By the time they both reach retirement, the gap between them isn't just significant, it's almost impossible to close. This video is going to show you exactly why that gap exists, what creates it, and what you can do right now to make sure you're on the right side of it. We're going to keep this simple. No jargon. Just the numbers, the tools, and the decisions that actually matter. Meet Alex and Jake. Alex is 25, he earns $100,000 a year, take home around $6,200 a month after tax. On the day he receives his first full paycheck, he does one thing before spending a single dollar on anything else. He opens a Roth IRA and sets up an automatic transfer of $583 a month. That's $7,000 a year. The maximum annual contribution the IRS allows for 2025. He puts that money into two index funds, VOO and QQQ. We'll explain exactly what those are in a moment. After that transfer is made, the rest of his income is his. He lives well, he's not depriving himself, he's just made one non-negotiable decision. Invest first, spend second. Jake is also 25, same salary, same city. Jake spends his income, not recklessly, he pays his bills, he covers his rent. But he upgrades his life with every raise. A BMW lease at 25, a nicer apartment at 28, vacations every year, designer clothing, the latest phone every cycle. Jake tells himself he'll start investing next year. Every year, next year comes. The investing never does. The only financial difference between Alex and Jake at age 25, $583 a month redirected from spending to investing. What is a Roth IRA? A Roth IRA is a retirement account created by the US government specifically to help individuals build wealth tax-free. Here's how it works. You contribute money you have already paid income tax on. These are called after-tax dollars. That money is then invested. It grows over time, and when you withdraw it in retirement, after age 59 and a half, you pay zero taxes on any of it. Not on the contributions, and not on the growth. That means if you put in $7,000 a year for 40 years and it grows to $3 million, you owe the IRS nothing when you take that money out. 2025 Roth IRA limits. $7,000 per year under age 50, $8,000 per year at age 50 and over. To contribute the full amount, your income must be under $150,000 as a single filer. You can open a Roth IRA at Fidelity, Vanguard, or Schwab in under 15 minutes. What are VOO and QQQ? These are the two investments Alex puts his Roth IRA contributions into every month. Neither one requires stock picking, market timing, or any financial expertise. VOO is an ETF, an exchange-traded fund, managed by Vanguard. When you buy one share, you are buying a small piece of all 500 of the largest publicly traded companies in the United States. Apple, Microsoft, Amazon, Google, JP Morgan, Johnson & Johnson, all of them, in a single purchase. You are not betting on one company. You are betting on the US economy as a whole. VOO's 15-year average annual return, approximately 13.5%. Its expense ratio, the annual fee to own it, is 0.03%. That is 3 cents per year for every $100 invested. QQQ is an ETF managed by Invesco. It tracks the NASDAQ 100, the 100 largest non-financial technology and growth companies listed on the NASDAQ exchange. This includes Apple, Microsoft, Nvidia, Meta, Amazon, Tesla, and Google. QQQ is more concentrated in technology than VOO, which makes it more volatile. It rises more aggressively in bull markets and falls further in downturns. But over the long run, its 20-year average annual return has been approximately 15%. Alex uses VOO as the foundation of his portfolio: broad, stable, diversified. He uses QQQ as the growth component: higher risk, higher long-term reward. Together, this two-fund combination is one of the most commonly recommended beginner strategies among long-term investors. Alex does not watch the market, he does not trade. He sets up a $583 automatic transfer on the first of every month, split between VOO and QQQ, and does not touch it. How compound interest works. The reason Alex's early start matters so much comes down to one principle: compound interest. Compound interest means your investment generates returns, and then those returns also generate returns. You are earning on your earnings, not just your original contributions. Here's a straightforward example. Year 1, Alex invests $7,000. At a 10% annual return, it becomes $7,700. On year 2, he now has roughly $16,170, not from 2 years of contributions alone, but because the first year's growth is also compounding. Year 3, the same thing happens. Now the growth from years 1 and 2 is also growing. In the early years, this feels slow. The numbers are small, but around year 15 to 20, something shifts. The compounding starts to accelerate in a way that becomes genuinely hard to comprehend. The rule of 72. Divide 72 by your expected annual return to find out how many years it takes your money to double. At 10%, money doubles every 7.2 years. Alex's $7,000 invested at age 25, $14,000 by age 32, $28,000 by age 40, $56,000 by age 47, $112,000 by age 55, all from a single year's contribution, without touching it once. What happens over the next 20 years? At age 35, 10 years into investing, Alex's Roth IRA has grown to approximately $122,000. He has personally contributed $70,000. The market has added $52,000 on top of that. He did nothing to earn that $52,000 except start early and leave it alone. Now let's take a look at Jake. Jake at 35 has no investments. His income has increased. He earned a promotion at 32, now making $120,000. But his spending increased with it. His net worth outside of physical possessions is close to zero. By age 40, Alex's Roth IRA, $245,000. Jake's savings account, $8,400. Same income bracket for 15 years. The only difference is the $583 monthly decision made at 25. At 45, Jake's company downsizes. His position is eliminated. He receives 3-month severance. He opens his banking app for the first time with the intention of understanding his full financial picture. Checking account, $14,000. Savings account, $11,000. Retirement accounts, $0. His fixed monthly expenses, rent, car payment, subscriptions, food, total approximately $5,000 a month. His severance plus savings gives him roughly 4 to 5 months of runway. After 20 years of earning a 6-figure salary, he has less than 5 months of financial cushion. 68% of Americans live paycheck to paycheck. The median retirement savings for Americans aged 44 to 49 is $81,347, roughly 18 months of median household expenses. A single job loss at the wrong time can erase years of financial stability when there is no investment base behind it. Jake starts at 45. What that actually means. Jake begins investing immediately. He opens a Roth IRA, contributes the maximum every year, $7,000, then $8,000 once he turns 50. He puts everything into VOO and QQQ. He does not miss a single year. He is disciplined, he is consistent. He does everything right, starting at 45. Here is what both portfolios look like at age 65, assuming a conservative 10% average annual return for Alex and Jake. Remember, one stared at 25, the other at 45. Alex total contributed $280,000, while Jake $155,000. Portfolio at age 65, Alex's surpasses a whopping $3,100,000 account, while Jake's does not even reach $500,000 with just $430,000. Taxes on withdrawal will be zero for both. Alex contributed $125,000 more than Jake over his lifetime, but he ended up with $2.67 million more. That difference is not explained by income, intelligence, or opportunity. It is explained entirely by the 20 years of compound growth that Jake's money never had. Jake's $430,000, withdrawing $3,000 a month, runs out around age 77. He will likely need to keep working or significantly reduce his withdrawals. Alex's $3.1 million at the same withdrawal rate lasts over 80 years. If his portfolio continues to grow at 10% annually, which historically it can if left partially invested, he will never draw it down to zero. If you are under 50 and earn under $150,000 as a single filer or under $236,000 as a married couple filing jointly, you are eligible to open and contribute to a Roth IRA today. Step 1. Open a Roth IRA at Fidelity, Vanguard, or Schwab. It takes 15 minutes online. There is no minimum balance required at any of these three brokerages. Step 2. Once your account is open, purchase shares of VOO and QQQ. You do not need to invest the full $7,000 on day one. You can start with whatever you have, $100, $500, $1,000, and add to it over time. Although if you are older, maybe choose something a little bit more conservative. There are plenty of options that do not expose too much to riskier assets. Make sure you do your own research on which best fits your investing style and risk tolerance. Step 3. Set up an automatic monthly contribution. Automate it so the money moves before you have the option to spend it. This is the single most effective habit in long-term investing. Step 4. Do not touch it. The value of a Roth IRA is in its long-term compounding. Withdrawing early eliminates that advantage entirely. The difference between Alex and Jake was not a large sum of money. It was $583 a month. Automated, consistent, left alone. If you cannot contribute $583 right now, start with $200. Start with $100. The amount matters less than the habit and the time you give it. And final word. Most people are not bad with money. They were simply never taught how it works. The Roth IRA has existed since 1997. VOO has existed since 2010. QQQ since 1999. The information to build real long-term wealth has been publicly available for decades. What most people lack is not access, it is clarity. If this video gave you that clarity, share it with someone who needs it. A friend, a sibling, a colleague in their 20s or 30s who has never opened a brokerage account. The most expensive thing you can give someone you care about is financial silence. Subscribe to The Wealth Fable for a new video every week. Every video is built around one goal, giving you the financial knowledge that used to live only behind expensive advisors and closed doors. Spend wisely, invest early, stay consistent.